they are beating estimates massively, massively beating estimates, right? 61%, that doesn't even make sense. Who would have been surprised? 84%. 84% EPS beat. Welcome back, my name is Arya. I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, we're going to go over my favorite company of all time. It is, in fact, AMZN.com. AMZN.com is a company which I started investing in the August of 2022. Yeah, I want to say August of 2022. It is a company which I have absolute belief in them executing for years to come, which should lead to outperformance on a going forward basis. In today's video, we're going to just lay my entire thesis on the company, why I think it can outperform, what I think the key growth drivers of the company are. Spoiler, it's AWS and the ads business. But before we dive into that, I've tried configuring this face cam for this video, and it's just, for some reason, it's not synced. I apologize for that in advance. But anyways, let's move on. So to jumpstart everything, we're over here on FinChat, and what I want to do is I want to go over all the different revenue segments of this company. So I want to go over just to get a holistic view of how significant each revenue stream of the company is. We're just going to go over all the different ones. So starting us off, we got the online stores revenue coming in in the last 12 months, $235 billion, that's right, $1 billion of revenue from that front of the business. This is, of course, all the revenue that Amazon collects as you buy stuff on their online stores, right? Second item here is the physical stores revenue. So this is your Amazon Fresh and as well as your Whole Foods and that type of stuff, right? So the revenue they get from there, it's 20 billion off of roughly 600 billion. So that lands you at roughly 3%, just over 3% of revenues, right? It's not really, it doesn't move the needle. You know what I mean? It's pretty much stayed flat for the past couple of years, right? Moving on, third-party sellers. So if you didn't know, Amazon actually charges, like when you go onto Amazon, it's either Amazon selling you that item or it is third-party seller selling you that. So when you go onto the Amazon website as a third-party seller and you're trying to sell something on Amazon, they'll actually charge you on various different things. So if they're storing your product, if they are shipping it to the customers, all that type of stuff, there's little fees incorporated into all this different stuff, right? Moving on, advertising service revenue. This is like a really hidden part of Amazon.com is the advertising revenue, which has just had explosive revenue growth in the past, like give it 5 years or so, right? So they went from 38 billion in 2022 all the way up to 47 and then 49. The significance of this part of the business is that every time you go onto Amazon.com and you search, I don't know, whatever, and I keep going back to the same example, the iPhone charger. When you search up the iPhone charger, the first 4 results is almost always, it's always going to be sponsored. What that means is someone paid for their product to be showed before other people's product, right? And that has turned into a business in advertising dollars that's bigger than Netflix, bigger than YouTube, bigger than any other social media except for Facebook, right? Furthermore, here we have the subscription services revenue. This is your Prime, right? So for the most part, this is just Prime revenues, but as of recent, they actually put a $3 tier for Prime Video. So I guess that gets grouped into here. Alexa Music or whatever that thing is called, that also gets grouped into here. I would assume Twitch subscriptions also get grouped into here. So as you can see, this has been like the original business model of Amazon, having the online stores, and then you charge a membership fee to get onto the stores and be able to buy and have fast shipping and all that type of stuff. Essentially the Costco model, just online. Yeah, it's a very core part of the business, very strong part of the business, but it isn't really growing much. I'm not like particularly bullish on that side of the business. Obviously it's going to continue growing and it has extremely high retention rates. But then again, like as we'll dive into here, we got other parts of the business that are more core to my thesis. Moving on, this is the holy grail. This is AWS, also known as Amazon Web Services. The reason I'm personally invested into Amazon comes down to 2 things. It's the AWS and the ads business. Those are the 2 things that I'm extremely bullish on. And AWS, as we'll dive into here, the reason I'm so bullish on it is because of the incredible switching costs when it comes down to getting off of AWS. Now, some of you guys might be experts on AWS. I got many viewers that are developers or otherwise are very familiar with AWS. Maybe it's the 1,000th time you're hearing about AWS. But for those of you who don't know what AWS is you might have seen these in movies, right? These data centers and data server racks and all that type of stuff. Essentially, the reason why we have this is to host data or like a website on the internet. You need these servers to send over packets of information, and when, like, for example, you go on Amazon and you click to put something in the cart, like that data needs to be stored somewhere. How is that stored? It's these big ass excuse my language, it's these data servers, right, where they store tons and tons of data. I'm sure you guys have seen these in the movies. So traditionally, maybe 20, 25 years ago, the idea was that if you wanted to host anything on the internet, right? If you're like some big bank, if you're JP Morgan Chase or whatever, right? And you want to have a presence on the internet, or if you're Walmart and you're transitioning from brick and mortar to having an online presence, you need to have your own IT infrastructure and like these, like the servers and all that type of stuff. And you need to hire people to maintain that and make sure it doesn't go down and all this other stuff, right? And it was very costly, but it's a very essential part of the business in order to be an internet company. The revolutionary idea that Amazon came up with was, hey, why is it that you have to try to predict, okay, let's put like a 1,000 square foot data server here because during the winter months, we're going to need 90% of this capacity, but then for the rest of the year, we're going to need 15% of this capacity. But just because we need that 90% capacity for those 2 months during the winter months, during the holiday season when everybody's going and shopping, we need to have all this excess capacity that we're not going to use just in case we end up using it one day, right? Amazon's revolutionary idea, why don't I build the servers, and I build a lot of servers. So not only Walmart can I serve you, but I can also serve JP Morgan Bank and United Health Group and so on and so forth, and this hospital and that hospital and every single other business around the world. I could serve all of you. I could rent you this capacity for a certain amount of money, but this way you don't actually have to upkeep and you don't have to maintain it and you have to do any of that. Companies like Cisco, IBM, and Oracle previously, what they would do is they would sell the networking equipment and the parts and all that type of stuff for these big servers, right? They would sell it to JP Morgan. They would sell it to United Health Group or Walmart.com or whatever, right? Like they needed all this IT infrastructure and they would sell that IT infrastructure to them. What Amazon started to do is they started to buy up all that and then just start renting it out. Just pay as you go, right? Instead of having all this capacity that you don't use, right? And you only need it for 2 months, why don't you just use the 15% capacity for the entire year, and then for those 2 months that you need a lot of capacity, no problem, we're flexible, pay as you go. As long as you meet a certain minimum, right? As long as you meet the bottom 10%, the 15% capacity that we agree on in your contract that's written that you have to pay for, as long as you meet that, no problem. Scale up as much as you want, and we'll keep collecting those rental fees, right? Like it is essentially a rental fee. They're renting out their data servers to all these different companies and letting them use it as they go, right? And this creates an immense amount of flexibility, and that is why it is just so incredible, right? So previously you had IBM, Oracle, Cisco, all these different companies with massive profit margins, and I quote David Rosenthal from the Acquired podcast, your margin is our opportunity. And that's exactly what Amazon did. And they came in and they swept through and they just they built all these data servers and created the cloud computing model, which is now dominated by AWS, Azure, and Google Cloud. With that being said, I hope I gave a pretty good idea of what the cloud computing model is. Obviously, it's incredibly more complicated than that, but that's essentially, to boil it down, that is the simple version of it. Okay, Arya, great. So we got this cloud model. It's an incredible model, but what, the total addressable market, when is that reached? Like, hasn't cloud been around for like 2 decades? Isn't it pretty mature? Like, sure, the growth rate's fast, but isn't that going to slow down in this decade? So I have this article here from Forbes, and we're not going to go through the entire thing, but I found a couple key bullet points here, and they go on to say, according to Gartner's forecast, Gartner is like a research type company, right? They research and forecast and all that type of stuff. Very interesting company. I might do a video on that later on. But according to Gartner's forecast of public cloud services worldwide, an estimated $500 billion in cloud spending in 2022 accounts for only 11% of total IT spend. So of all the money spent on IT infrastructure and building these servers that we were just looking at over here, of all the money that's spent on all that, only 11% is equivalent to the amount that's spent on the cloud, right? So the pay-as-you-go model, the renting model of JP Morgan Chase and United Health Group and all these different companies coming to Amazon and being like, hey, we need to use your IT infrastructure, that's only 11% of total IT spend. So most of IT spend is still on servers of big companies using or creating these data servers for themselves, and it's like a one-time big capital expenditure cost, and then they end up not using a lot of it, right? So it's never going to be 100% cloud and 0 on-premise, but the balance between cloud and on-premise, it'll start to, I don't know, maybe in 10, 20 years from now, it'll be more like 20, 30, 40% compared to 60% on-premise. Of course, there's always going to be a group of companies that will want their own servers and to upkeep that and all that type of stuff. There's advantages and disadvantages of going on the cloud. That's what I'm trying to say. Moving on, they say by 2023, cloud spend is projected to reach $600 billion, or about 12% of total IT spend. So you see, like, it's incrementally moving up, right? They're gaining market share incrementally. By 2026, that percentage of IT spend climbs to 17%, right? And you might want to take Gartner's numbers with a grain of salt, right? They're obviously not always going to be right, but anyways, based on current growth rates, we expect that cloud services will one day account for at least 25% of global IT spend. This is so vague. I'm honestly disappointed in this. But anyways, as you can see, over time, we should see a shift towards more cloud computing as opposed to on-premise stuff, just because of the flexibility and all that type of stuff, right? So I've covered what cloud is and that it's consistently gaining market share against on-premise, but I want to go over, and of course I use ChatGPT because why the hell not? Like, it's such a great research tool. If you have companies that you don't really understand, like cybersecurity companies or something, highly recommend bouncing ideas back and forth with ChatGPT. Great study partner. But anyways, I just very simply asked, why would someone be bullish on the cloud? And they kind of said what I've been talking about this whole video, right? An immense amount of scalability, immense amount of flexibility as well, right? Like you scale up, scale down, whatever, and cost effectiveness, right? So compared to, let's just say the Walmart scenario, right? If they need 90% capacity for like 2 months, but then 15% for the rest of the year, if you go with AWS, then you could just spend that 15% and then scale up to 90% and then right back down to 15% capacity for the duration of the year, right? So if Walmart were to actually make those servers themselves, they would have to spend a lot more on IT capacity that they don't use and then go back to using like the minimal amount, right? So it is at the end of the day cost effective for companies like that, right? Goes on to say some other garbage, innovation, security. Security is a real thing. So if you have Amazon, which I don't know about Amazon specifically, but I know GCP, Google Cloud Platform, which is Google's cloud computing division, it's like 5 layers of security just to even get in the data centers. Like it's an incredible amount, because it is at the end of the day customer data, right? Like if there's ever a customer, or if there's ever like a data breach or anything like that, like that's very, very bad reputationally. So it's incredibly important for Google and all these different cloud computing companies, Azure, Google, and I say Azure, Microsoft, Google, and Amazon, to have an immense amount of security around all this data and all that type of stuff, right? Moving on, data analytics. So if you have your data stored with Amazon, over time they're able to provide you, like even as I've started to create YouTube videos, you can see this on the YouTube Studio app. It gives me like, okay, you had this many comments this week, you had this many likes, right? You have all these like key data points that they're able to summarize for you and give it to you, and then possibly try to sell it, right? So this is a progressively larger part of Amazon's business, where they could provide you with analytics on your data because they have your data, right? Then I asked ChatGPT, what is the similarity of cloud computing and utility companies? So the reason I gave it this, I believe I saw this on Twitter, and I wish I could find the tweet, but kudos to whoever came up with this analogy. Utility companies and cloud computing. So if you didn't know, and we'll go ahead one slide here, but the factories of, I don't know, like 100, 200 years ago, they used to actually need to generate their own electricity to be able to run the factory. So if it's like an automobile factory, right, they're making Ford cars or whatever the case is, they would actually make their own electricity to keep the car line going, right? So you could see how this is a little bit unnecessary, right? Like, why not just outsource that? At the time they didn't have that, but over time society kind of realized, like, hey, why don't we just create like a central utilities company, right? So for electricity, for water, for gas, for like literally all the utilities, why don't we just create that central thing, and then we just pay them like $50 per month or whatever the case is. At the time it might have been different. We just pay them $50 per month, and you supply us electricity, and it's pay per use, right? It's pay as we go. Compared to, let's just say, if you were to actually generate your own electricity, you would need to create these big, I believe, what are they called? You would have to create these like wind power thingies, steam power. Yeah. So you would have to create these steam power thingies, and then based on that would cost you like a lot. Like, again, similar to the data centers, it would be an upfront capital investment that you would have to put down, and then that would continually generate you the electricity. And of course, it has costs of running it and all that type of stuff. It just makes sense to go with a utility company and pay them $50 a month, right? A lot less headache. It's something business critical that you have to have, but it doesn't necessarily translate to revenue, right? Same thing could be said about cloud computing. So again, I asked ChatGPT, what is the similarity of cloud computing and utility companies? It says pay-per-use model, right? So pay as you go, compared to put up this big capital investment up front. I've probably repeated this about 5 times this video. Scalability, right? So scale up, scale down, flexibility with the utilities company, with the electricity. If you spend 100 gigajoules of energy, you're going to pay 100 gigajoules of energy. But then if the following month factory shut down, your workers are on protest, you're only spending 5 gigajoules just to turn on the office lights, you're going to pay for 2 gigajoules of electricity, right? So scale up, scale down. Infrastructure, right? Both types of services rely on a complex infrastructure to deliver their services. Utility companies have network of power lines or water pipes, which cloud computing providers have data centers and networking equipment, right? So if you're a startup, right, and you're a brand new company, you're just coming up, it doesn't make sense to put all this big investment into IT infrastructure if your business model isn't even proven. It just makes sense to start off with a small bill on cloud computing and go like that. Reliability and redundancy, right? So if you get like two different cloud computing companies, if you get Azure and AWS, there's redundancy if one of them goes down, whatever the case is, and then you're not on the hook if your own data centers go down, right? I believe 5-6 years ago, there was a case where Spotify went down, Netflix went down, PayPal went down, all these different companies, they went down. Why? Amazon Web Services went down, right? So if Amazon Web Services go down, all the companies go down, and you could kind of just like blame them, right? They could throw them under the bus. Yeah, it's Amazon's fault, whatever, right? So I guess from an executive perspective, there's that aspect of things as well. Moving on, just because I see the video is running pretty late here, I wanted to go over just some of the very basic. I've talked about Amazon extensively in my videos past. You guys could go over there, but some of the basic valuation metrics of Amazon, right? PE, which is a valuation metric which I absolutely hate, but that's a topic for another video. Trailing PE of 53, and the company is expected to grow at roughly 14% in the next 2 years. 40% in the next 2 years, right? That would give a PEG of roughly 1.3 times. Price to earnings growth ratio, which is something I refer to, right? Like it doesn't make sense to call a company expensive just because the PE is high. What if it's growing incredibly fast, right? The case of Nvidia being top of mind, right? So you have to consider the underlying growth rates of a company compared to the valuation it's trading at. And in the case of Amazon, it's expected to grow incredibly fast. And what's amazing about Amazon particularly is that not only is it growing incredibly fast, right? It's expected to grow at 40% in the next 2 years. But on top of that, it's a company that is consistently beating these estimates, right? They have this massive, massive target on their back, which is an immense amount of growth. But not only are they coming in line with that, they're actually beating that by a large, large margin. If you just go over to the past couple quarters, and I'm not saying this is going to continue out into the future, I think there's a lot of expectation built into Amazon stock as it's literally trading at all-time highs. But anyways, let's just go through the past couple quarters. In the most recent quarter, they beat EPS by 16%. Pretty good. A 16% beat. Usually companies come in line, maybe a couple digit miss, couple digit above estimates, right? But Amazon beat by 16%. That's a 16% decrease in the forward valuation of the company, right? If the PE was 40, all of a sudden the forward PE is 16% less because they just beat by the forward PE estimate. Moving on, 26% in the February quarter, right? This is the quarter where they had the massive amount of free cash flow. This is Q4 2023 quarter, right? So again, 26, that's an incredible amount of earnings per share that they're beating by, right? Let's just go back one other quarter, 61% EPS beat. Now, of course, again, this is all priced into the company now. This is a quarter that was, 6 months ago? But nonetheless, it just goes to show that since Amazon turned on the profitability wheels, they are beating estimates massively beating estimates, right? 61%, that doesn't even make sense. That just slashed the forward valuation of the company in half. It slashed it in half, right? Just absolutely incredible stuff out of this company. I'm going to go back one other quarter. Who would have been surprised? 84%. 84% EPS beat. I'm going to stop right there because I think it starts trailing off after this. But nonetheless, you guys understand my point here. Amazon is a company that on a forward basis, they just have a tendency of beating EPS. Again, I'm not saying this is going to continue. I think this is actually incredibly unsustainable, right? Just to keep beating and beating and beating. There is going to come a day where they miss or they come in line or they beat by 5%, right? It's not going to continue. But nonetheless, goes to show that not only is Amazon growing at 40% EPS, but on top of that, they're beating those estimates, right? So really starts to put into question the valuation of the company. Sure, it's a 53 trailing PE, and on a forward basis, it's just shy of 40, right? But is it really? Like, it could be cheaper if they continue beating like this, right? And expected long-term growth rate, 23%. This is the 3 to 5 year EPS growth rate that they've assigned to the company. Jumping over to my spreadsheet, not this one, jumping over to my spreadsheet that I include in every single one of my videos, you guys will be able to see that I've actually assigned, let's find Amazon here. I've assigned Amazon a 45 times price to free cash flow multiple based on the estimate that they're going to do about $62 billion in free cash flow, which is a bit conservative, but nonetheless, I just did this just so I got called like an Amazon hyperbole or anything like that, right? So why does that mess up? Anyways, I'm not going to sort this for you guys just because this Uber thing is giving me a hard time. Nonetheless, you guys can see, right? So this is the valuation framework that I use in every single one of my videos. And long story short, how it works is it's very similar to the PEG ratio. So it takes the current free cash flow valuation of the company, right? We have that in column I over here, the price to free cash flow multiple of the company, and it divides that by how fast we expect the company to grow those free cash flows. So in the case of Amazon, which is the topic of this video, you're trading at roughly 45 times forward price to free cash flow. And this could very easily swing, by the way, right? So if you all of a sudden assume that they do $70 billion in forward free cash flow, right, in the year 2024, might I remind you, they're doing about, actually, let's go check, just so I don't make a mistake here. On a trailing 12-month basis, with only one quarter of 2024 underway, they've done $46 billion of free cash flow. So if you believe in the next 3 quarters, Amazon is going to muster up roughly $25 billion of free cash flow per quarter, right? Might I remind you that Q4 is a historically like just amazing quarter, right? If we switch this to the quarterly view here, you would see that, yeah, Q4 of last year, they did 28 billion, just Q4 alone. So if you guys believe that on a going forward basis, Amazon does about $8 billion of free cash flow per quarter on average, then they arrive at that $70 billion number, right? So, and then they arrive at that $70 billion number. I'm assuming a 30% of that is stock-based compensation. So again, if we go back over here, down into the, I believe it's operating, yeah, stock-based compensation. Yeah, so you would see that, and then let's switch it to annual over here. Yeah, so you would see that it's about $24 billion of stock-based compensation that you can just deduct from the free cash flow number, because that's equity that is leaving the business that you no longer own. That's the amount that they're paying to their employees, right? So if you were to deduct that, that comes out to about a 30% mark. So 30% stock-based compensation on $70 billion. So you're landing at roughly a 40 times price to free cash flow number. And if we assume it's growing at 22%, might I remind you that the EPS is at 40% and the EPS long-term is actually just a little bit over that, right? So if we're assuming the ratio stays the same, which again, big if, nonetheless, if you apply 22% free cash flow growth rate, which is possible, right? Like it's definitely not out of the question. Just last year, they increased at 100%. So I'm assuming annualized, that'll be around a 20% mark on a going forward basis. This company is trading very cheaply. It's undervalued as it stands currently. The free cash flow to growth multiple is under 2, right? So the amount of growth you're getting for the price you're paying, it comes off undervalued. With that being said, I'm going to jump over to my portfolio tracker. I might start doing this out into the future. And I have this pinned in my bio as well on Twitter, right? So this is what the portfolio looks like currently. I'm going to just maybe chuck this in at the end of the videos from now on and maybe talk about what I'm thinking about the portfolio, whether or not I'm thinking of trimming anything, what I'm buying. This doesn't include cash I have, but the cash I have is like 0.5%, right? So nothing really meaningful as it stands currently. I like the Amazon, Google, and CRM positions. The top 3, I love that. I'd maybe want to add to Google a little bit more if there was a big drawdown in the company. I'm very upset I wasn't able to buy more when it dipped down to 130. It is what it is. I'm happy stacking up my gains. One thing I'm thinking of doing is getting rid of Starbucks. So I tweeted about this recently, but I am very much strongly considering getting rid of Starbucks. I do still own shares of Starbucks, but if I were to get rid of it, I would maybe add a little bit more to Paycom. I'm liking how Paycom is looking right now. And additionally, I would probably just throw it all into SCHG. I'm thinking SCHG is a great ETF. I've looked through like almost every single growth ETF. I've looked through them all. I've looked through the Russell 1000 growth, SPY growth, SPY G, all the different ones, right? QQQ, all the semiconductor ones, every single one of the ETFs. I just went down the list, look at all the methodology. SCHG seems to be the best one, right? It's very complicated how they actually arrive at all these different companies, but based off the allocations of the companies and all that type of stuff, I really like that one over all the other ones. With that being said, if I do get rid of Starbucks, you'd be first to know about that, and I would probably do a video about that, all that type of stuff. I'm going to get rid of Starbucks, and it would mostly go into SCHG. Last, I want to ask you to do something that costs you nothing, but would help me out greatly. If you could please hit the subscribe button. You could always go back on that decision if you end up not liking the videos, but I highly doubt that. I will continue to make high quality videos just like this one. Go ahead and check out my Twitter to see my live portfolio if you're watching this in the future. With that being said, thank you for watching. Have a great day.